Hello and a warm welcome to this week's edition of Invest Africa. I'm Bronwyn Nielsen. Risk is part of everyday life, and insurance companies are in the business of identifying, measuring and managing this risk. This week we take a look at the role of insurance on the African continent and its role in catalyzing economic growth.
Africa's insurance market remains very small when compared to that in developed countries, where this market contributes only 2% to GDP and caters to less than 5% of the population. Insurance is a grudge purchase and is therefore heavily influenced by income levels, which is why the global financial crisis was a drag on the global insurance industry. Apart from low per capita incomes, capital inadequacy, lack of capacity and underwriting expertise are just some of the issues plaguing the African insurance market. But there is still an incentive for companies and investors to be looking into the sector. According to the South African Centre for Financial Regulation and Inclusion, insurance companies in most African markets have traditionally targeted only the top 5% of the adult population. Insurance companies in these markets tend to fight for market share in an already served market and should start to extend their reach. For example, less than 30% of low-income adults in South Africa have any form of insurance, whilst in the rest of Africa, this untapped market could be as much as 40%. An intimate understanding of the economic circumstances is needed for this low-income market, and it'll be interesting to see if sub-Saharan African insurance companies will embrace this new market. It could very well prove to be as successful as microfinancing has been.
Joining me in studio to take a closer look at insurance in Africa is Jaco van der Sant. He's the head of insurance KPMG. Guy Scott, CEO of Aon Risk Solutions, and Risto Katola, insurance analyst, SBG Securities. Well, gentlemen, let's just map out the insurance sector in Africa. It obviously is a competitive one, but do we have traction with the population as set out in our insert when it comes to insurance? Isn't this something that perhaps is for a more developed environment when there are greater needs on the table than perhaps insuring yourself against risk?
Bronwyn, I think that is one of the key challenges in Africa at the moment, is that there's limited means out there. And that's why we see the personal lines market taking off very slowly. So at the moment, the market is more around the corporate and commercial areas. We hope that as the middle classes develop in these countries, that will spill through to personal lines insurance as we know it in South Africa.
Can we add, Guy, in terms of your thoughts? What are we facing here?
I mean, certainly South Africa is the dominant insurance player in the market, and so the opportunities lie north of our borders. I think we've got to be very careful when we venture north of our borders, and it's rather surprising that some of the indigenous South African insurance companies haven't made a broader foray on the African continent. The African continent is largely made up of your smaller indigenous insurers in country, whereas effectively the likes of Santam, Hollard to a certain extent has some sort of footprint in Africa, but then they're also beyond that in other emerging markets in terms of India and Pakistan, even Australia. But certainly their footprint is not in excess of 4 or 5 countries on the short-term side. So to my mind, there's huge opportunity. You see the globalization or the regionalization of South African business, where there are risk requirements and requirements for insurance is of an absolute necessity. And I think from that point of view, that is the opportunity. It just depends on which segment you're looking at. Certainly, as Jaco says, personal lines, commoditized business. I think with the look to consumerism, you are getting more and more traction in that segment. So I do support your view on that point.
Risto, would you say the South African insurance companies are late to market when it comes to the African opportunity?
I don't think so. Now, first we need to realize that this market is still not very big. Okay, so the non-life insurance industry in the rest of Africa, the total size is about the same size as the South African industry on its own. On the life insurance side, the rest of Africa is actually, I think it's about 1/6 of the size of South Africa alone. So particularly on the life insurance side, in some ways they're very early entrants still. On the non-life side, which these guys have mainly been talking about, there the market is a little bit more developed because anyway you've got industrial production or assets, somebody needs to insure them. But in a lot of these countries, they also have localization rules, which means that it has to be underwritten through a local player. South African companies are looking at Africa a lot. It's just maybe a bit early to be expecting them to make billions of rands there, because the profit pool just isn't big enough.
The localization rules must be a challenge, specifically because they must differ territory by territory.
I think localization is not so much of a problem in most of the developed world. You need to be registered in country as a registered insurance company to do business there. So it's nothing different in Africa than South Africa. So most of the companies will be looking at either forming new operations there and applying for licenses, or through mergers and acquisitions, acquire licenses. I think the greater challenge is that there are certain reinsurance capacity constraints in Africa. And also forced layoffs to local reinsurers. In fact, I strongly have a view that whoever puts down the greatest capacity in Africa will be the real winners. There's a lot of business that's leaving the continent at the moment because of a lack of capacity. Now, if you can bridge that gap, needless to say, you should benefit from the business.
Guy, I just want to come back to the names that you were throwing out. If you categorically had to say this is the leader, the lead player on the African continent, who would it be? And not Aon. You can't. We've got to put some Chinese. We've got to put some Chinese walls in here.
We are in the intermediary space, so we have a good footprint from an intermediary perspective. So we don't underwrite risk. We merely play a risk consulting and intermediary role. So your big indigenous players, certainly Hollard, have a good footprint. Mutual and Federal to a lesser extent, more in the Southern Africa region. Namibia and Botswana and Zimbabwe. You've got then some of the global players. You've got the likes of Chartis, who are in Zimbabwe, Kenya and the Middle East, so outside of the boundaries of Africa. But certainly very narrow footprints at this time. And that is the opportunity.
Do you agree with the names being thrown out there from an investment case perspective, Risto?
Yeah, I do. I just want to go back to the earlier point about reinsurance, that Santam has been speaking about that quite a lot, in terms of, rather than establishing a presence in every small country, rather offer reinsurance capacity from South Africa across the continent. So you let the local insurers basically chase the business and so on, but Santam will put its balance sheet and its technical expertise on the line. So I think that's not a bad strategy of increasing a presence in Africa, acting as a reinsurer for the local players.
You want to add to that point, Jacob?
No, I think it's one of the strategies. Only time will tell whether it's really that successful. Our research to date shows that Africans are quite interested in brands in their countries. So we do believe that if you establish one or two of the global brands in country, you will benefit, even more so than reinsurance. But clearly reinsurance is a strategy. It's something that has been applied by Santam quite successfully over the last couple of years. The thing is, there you will always compete then with regional reinsurers, professional reinsurers, and the likes of Africa Re springs to mind there, who in a way is protected by many countries having a forced cession to them. There's also PTA Re, there's a couple of them that are there that do have dominance. And then, needless to say, with reinsurance, unless you've got a real strategic alliance with your cedants, you are following their fortunes. So you need to be very careful in who you pick in that market space. But it is a strategy, and it is one of Santam's big strategies.
Guy, you wanted to take that
Yeah,
thought
I
further as well.
think South Africa is a hub for Africa in terms of providing that additional capacity, and whether it's through primary insurance markets or reinsurance markets, that is a reality and an opportunity, and it's happening. I think South African business, which is regionalizing, they want to have structured programs which meet their risk profiles and their needs, and therefore the underlying security as well. But I think we've got to be very careful that we don't ignore the local insurance companies. The expression, and we're proudly South African, so we don't like externalized premiums to international markets where we've got capacity in South Africa. So it's the same factor for whether you operate in Kenya or in Nigeria or any other sort of African territories. They like to see their their capacity taken up in the first instance. But I think that's where South Africa can support the region in providing that additional capacity on your substantial risks. And there's certain risk categories like the petrochem or mining industry where in-country capacity is not available, and that's where we can certainly support the region in providing that capacity.
What we're seeing from the likes of an Old Mutual and a Sanlam in the African space?
Well, Sanlam's got a very broad presence in Africa.
Yeah.
I mean, Sanlam's actually quite a narrow presence, but Sanlam, the parent, is in Ghana, Nigeria, Kenya, Uganda. I mean, they got, probably them and MMI have the two broadest footprints in Africa. Old Mutual has recently stated that they want to increase their presence in Africa. Now, Old Mutual's always been quite an aggressive company once it sets its mind on something. So I'm assuming
Can they play catch up then?
Yeah, I mean, there are still some acquisition opportunities in Africa. I mean, for example, in East Africa, you've got a company like Jubilee Holdings, which is quite a big player. There's a number of listed insurance companies in West Africa. So, I mean, there's still room for Old Mutual to probably acquire a presence in a lot of these markets. That tends to be its style. At the moment, Sanlam and Old Mutual both make about R500 million a year in Africa. Now, that's a bit flattering because it's really all in Namibia, Botswana, and Zimbabwe in Mutual's case. Rest of Africa, places like Ghana, Kenya, you're doing well if you're making 20, 30 million rand a year. So it's small. The last thing I wanted to mention on those companies is, even though they're life companies, quite a few of them are talking about maybe acquiring short-term presence in Africa because that industry is a slightly more developed one. So basically buying a short-term insurance presence to get your brand out there, to make some distribution relationships, and then roll out life insurance at a later stage.
And that's probably a strategy that a number of companies are deploying, where you've got to go in with a short insurance arm and short-term insurance, and then the life will follow once there's traction.
Absolutely. Look, the rest of Africa is very different to South Africa, where we've got a majority of life assurance versus short-term. The rest of Africa is just the inverse, where short-term makes up to 90% of the market and life only 10%. I think for life you need personal insurance to kick on, and that's a bit that's not there. I think one of the greatest challenges in Africa is probably consumer confidence in insurance products. You know, there has been certain territories where, due to the devaluation of their currency, 3 zeros have been chopped off. Now, if you've put away money in life insurance products for years in the hope of getting that nice payout, and now all of a sudden your money is diminished, it doesn't do a lot for confidence.
Or for the industry as a whole, the perception.
I just want to add that Old Mutual and Sanlam have got the opportunity of having short-term arms as well, Mutual and Federal, Old Mutual, and so their expansion off the back of both classes of business. Similarly, Sanlam, Santam can have that strategy. But then I think you've also got the bank assurance factor through ABSA,
Standard Bank.
Standard Bank. Certainly the bank assurance models will prevail, and they have, in terms of financed assets, I mean, that's important in terms of sort of securitizing that debt, the insurance aspect to that. And I think from that point of view, that is the opportunity off the bank assurance models. But certainly where you do have a good footprint, you can replicate best practice and adapt to local geographic need and requirement.
We're going to come back to the bank assurance models right after this short break. As I said, we're taking a quick break. More Invest Africa when we return. Stay tuned. Welcome back to Invest Africa. Investors and emerging economies are expanding their footprint into the African market, and whilst doing so, will command the inevitable need for financial protection through insurance. Let's take a look.
Protection from intangible risks such as breach of contract and property rights is key, especially in a legal system that is often fluid. Political risk insurance, especially in Africa where post and pre-elections can lead up to instability, is particularly important for trade and investment. Adam Sami is the CEO of South African-based insurance company Lion of Africa, and having have been in the insurance industry for over 13 years, he shares some insights on the impact of regulatory reforms in this industry and what that has meant for further expansions into Africa.
The regulators make sure that that we're bringing in what is called a treat customers fairly regime, that we all play the game and that we don't charge customers for services we don't provide, and that the people with whom we do business, our accredited intermediaries, that they are of a particular quality and can deliver a service to our customers at a particular standard that is acceptable to our clients. This is now a legal obligation, and that's very different to the way the industry was characterized, really almost 3 years ago.
Even though insurance companies such as Charters have been able to achieve a global footprint in this very competitive market, being able to adapt to client demand is key.
First of all, you have to create the resources to comply with what has to be done, and like I mentioned, a lot of regulatory changes, and one of them will be TCF, Treat Customers Fairly, which has been implemented in the UK. So you have to build the scale and resource to make sure that your business is compliant. But then you also actually have to manage your costs, because we are what we call in a very soft cycle where pricing is still under pressure, margins are very thin. So the only way to survive and create shareholder value is you have to actually be smart in terms of your cost management. So your processes and your efficiencies have to be great. And the more scale you have got, the more you can be competitively in an advantage situation.
Most insurance companies will have reinsurance in order to mitigate risk exposure and to cover loss in a major event. This allows an insurer to expand more aggressively, increasing solvency, and ensures that they are able to deliver on mass payouts with less risk associated.
One of our most difficult claims in that early period was in fact a product liability claim, where a Nando's product in London was found to be defective, and we needed to get the action. It was a single product. We needed to get in there and recall the entire production line for the whole of Europe and America, back to South Africa. So it was a bit of a baptism of fire, but I think what it also did was it proved our ability to actually deliver the service that we sold and that we promised.
A conducive regulatory and supervisory infrastructure framework will serve global insurance companies well and foster consumer confidence as they press forward towards cross-border market liberalisation.
Still with me in studio, Jaco van der Sant, Head of Insurance, KPMG, Guy Scott, CEO of Aon Risk Solutions, Risto Katola, Insurance Analyst at SBG Securities, and joining us from our bureau in Kenya, Stephen Wandera, the Managing Director of British American Insurance Company Kenya. Thanks so much, Stephen, for joining us for the second half. And perhaps we can just go to a theme that we ended off the first half with, and that is bank assurance, whether that has any traction in East Africa, in your opinion.
Bank assurance certainly has acquired significant traction in Kenya. This is actually one of the main drivers of growth in the Kenya insurance industry over the last 3 years. The total number of lives that we believe have been brought into the insurance pool through mainly credit life insurance is over 2 million. So this is quite significant over the last 3 years, and we see more and more insurance companies setting up bank assurance units, bank assurance divisions, and likewise banks are setting up their own units which will interface with the insurance companies in order to generate value.
Risto, you wanted to pick up on the bank assurance discussion. Let's get your thoughts.
Yeah, well, bank assurance is quite critical because there's only two ways you can really get to the end consumer in most African markets. One is through an employer. So you convince the employer to buy health insurance or life insurance for his staff. And the other way is through banking halls. There's no independent brokers or 1,000-man agency forces like we have in South Africa. So bancassurance is an extremely critical way of getting the retail customer.
Life expectancy. Obviously, in Africa and South Africa, I think life expectancy about 49 years in South Africa alone. This is something that continues to plague the African continent. We fall behind most of the other emerging economies, Brazil, Russia, India, and China. How does this impact the insurance environment?
I think life expectancy is clearly something that must be factored into the pricing of products. The fortunate part is that the need for insurance products in Africa at the moment is quite unsophisticated. It is not looking at the largest payouts like we've got in South Africa. It's looking for almost bridging capital in the event of a death in the family.
So funeral insurance.
Funeral insurance, a lot of study policies, for instance. So if the breadwinner falls away, that the studies of the children will be taken care of. And those things can be priced into the insurance product. Obviously, affordability then does play a role. We will have to see how it develops as the life market takes off. The other good thing is the numbers of potential lives to be insured. That obviously will have an impact on the pricing as well. So it's important to get that scale going as quick as possible.
Guy, do you want to add there before I go back to Nairobi?
Yeah, sitting with an intermediary hat on, I mean, obviously bancassurance, the channel is direct. It cuts into the intermediary space, but that's where the intermediary is emerging in terms of its function and in fact conducting administration business in the volume commoditized space. And I think that is the opportunity to support insurance companies who don't necessarily have a presence on a country by country basis, that with a footprint they can utilize the administration hubs within sort of established business models, and that is an opportunity.
Stephen, I want to take advantage of your presence there in Nairobi to get a little more colour around the insurance environment in Kenya and obviously in East Africa.
Well, certainly Kenya is the most advanced country in insurance in Kenya, in East Africa, particularly with regard to insurance penetration levels and the total volume of business that is written. Having said that, when we are talking about 1% penetration as a percentage of GDP for life business in Kenya and 2% for general insurance, it shows that there's huge scope for growth. The industry figures were released this morning, and they showed that the overall revenues in the industry had grown 15.9% in 2011 over 2010, which goes to build up a compound annual growth rate of 16% over the last 6 years. I think it's noteworthy that within this time, GDP has grown by 2 to 5% at most. So clearly, the industry is thriving, and there are significant drivers of growth. A lot of the insurance companies in Kenya have adopted a regional strategy and have got either subsidiaries or sister companies operating in Tanzania, Uganda, Rwanda, and South Sudan. So Kenya has become the hub of insurance growth.
Stephen, I'm going to bring it back to studio here in Johannesburg, because this regional play on the African continent is certainly a discussion that we need to have when we chat about any sector. Stephen, they obviously setting out that a lot of insurance companies are playing the regional hub, the East African hub. Do we see that as the strategy going forward? So now we're looking at the West African hub, we'll look at the Maghreb Union, and we'll look at SADC as a play. In your experience, Jaco?
That's certainly what we're advising our clients, is to take a regional approach to it, to East Africa, West Africa, and then the more Central African region. That allows you to better make use of infrastructure. You don't need to create all the administration capacity in each country, as long as you've got the front office and the product provision in country.
I think one of the challenges is technology across the region, and that is a barrier to trade, for the want of a better expression. So I think the regionalisation supports a narrower framework of operation. But I think
you're saying the challenges are soft infrastructure, like technology.
Like technology, yes, yeah. But I think the big theme is consumption, and I think Africa is an opportunity for all of us, and the consumer, and drawing the consumer in, and the uninsured consumer as well. As you've got a bigger and bigger middle class creating, I think that is the opportunity. And I think those businesses that get their business models correct will in fact jump the competitive advantage.
When you value these companies, Risto, what are you looking for in terms of the model? What excites you when it comes to their traction on the African continent?
Because the existing profit pool is so small, it really has to be about growth. I mean, if you're starting with 20 million, there's no growth.
So you've got to look at it as an opportunity going forward and say this is where we do see the industry going.
Yeah, I mean, the growth markets, I would say probably Ghana is the one that I find the most interesting. It's a combination of good economic growth and reasonably good infrastructure and regulatory framework. Nigeria is a pure growth play, whereas it's a bit of chaos in terms of operating there. Kenya's got quite a well-established insurance industry, but the growth rates aren't quite the same as in West Africa. So, yeah, I mean, most of the companies I look at, the Africa component doesn't make up more than 5 to 10% of the valuation. So it's still not key, but it is a nice growth angle to have, particularly when insurers in Asia, Latin America, and other places don't have that same angle.
You can't afford to ignore it, in other words.
I think it's one of the markets you have to be in. I think also whoever goes there first, it does provide some benefits, although you'll have to pay school fees from time to time. It's the growth market. SA is not going to give you the growth, but this is not a short-term play. So when Risto says that he's not adding a lot of value to it at the moment, that's probably true, and that's why shareholders must accept that this is a long-term play. This is something that will yield the dividends in 5-6 years' time, EVAT.
Gentlemen, that's all we have time for. That's it. Thanks very much for joining us for this edition of Invest Africa. We'll be back again at the same time. Until next week, from me, Bronwyn Nielsen, and my guest, it's goodbye.